Now you're in the PowerPoint mode.
Oh, it's no longer on
Oh,
full
now
screen.
you're back. Now you're back.
Okay,
Now you're back to full screen.
cool. I see folks joining in. We've got Marco, Jared, Gary, and Sip. Thank you guys for joining. We'll get started here in a couple minutes.
The webinar is live. All right.
All right. I think we've got more people joining, and it's 8 o'clock. So I think we can get started. If you want to kick us off, Alex.
Hello, everybody. Welcome to another CCG Compounding Capital Group webinar. Tonight's webinar is going to be the state of the economy. And I want to thank you guys for showing up. What we're going to do today is we're going to go over the slides. And if you do have questions, make sure you pop them in the chat. And towards the end of the call, I will start going over all the chats and make sure we get every single question answered. This call is going to go on for approximately an hour to an hour 15. The content is going to be about 35 to 45 minutes. And then from there, it's going to be a Q&A. So thank you, everybody, for joining.
Awesome. Thank you so much, Alex. Well, without further ado, let's kick things off. The very first slide is something that our attorneys make us read. The strategies mentioned in this presentation may not be appropriate for everyone. Other options not mentioned may be more suitable for your specific circumstances. Please consult your personal accountants, tax advisor, and/or attorneys to discuss your specific situation. The information being presented in this webinar is purely for educational purposes and should not be taken as investment advice. While every effort is made to maintain accurate and current information, the possibility of errors and/or updates always exists. Cool. And thank you all for joining. I know it's late Thursday evening. Really appreciate you joining us, supporting us. Hopefully you get some value out of this webinar. We've been wanting to do this webinar to provide a bit of an insight into the current happenings in the economy. There's a lot of uncertainty in the economy right now. So I'm sure we all have a lot of questions, whether it's a good time to buy, what's happening in 2024, are we heading into a recession? So hopefully we can touch upon some of those points in this webinar today. My name is Jay. My roots are in technology. I worked in tech and cybersecurity space for about 10 years. Been doing multifamily investing for 4+ years now, with about 15 plus, about 17 transactions total since early 2020. And earlier this year, January of 2023, I transitioned to real estate full time. Jason, who is not on the call today, he's traveling in Asia. He's actually in Japan today, but he's one of our partners who has a data science background and helps us with underwriting and asset management. Alex, over to you.
So Alex Tam over here. I've had over 14 years of experience in business management, managed my own medical practice, opening a second practice as well, mentor and coach others on how to operate businesses. And I'm a general partner in over 200 units, $20 million plus in assets under management, and limited partner as well. So I get to see both sides on the limited partnership side and the general partnership side.
Awesome. Thank you, Alex. And John, over to you for a quick intro.
Sure. Name is John Stanley. Have over 25 years of investment experience, really focused on the bond market. So all about, exactly the topics we'll be talking about tonight. Been involved in real estate for probably about 4 years now, in different varieties, whether it's part of syndicates and LP, positions, or, JVs with some operators and friends that I've met through the business. I think it'd be interesting, to talk about a lot of the things we're going to hit tonight and the implications that we're going to see in particular on multifamily and real estate in general. So I think it's a very topical topic, especially at the end of this year.
Absolutely. And John is a very humble guy. He doesn't like the spotlight, so he's not on this slide, but he joined our team in the middle of this year. And as we go through the slides, anyone who doesn't know John will soon realize how smart he is, which is why he's part of our team. So very grateful to have John on the team. Well, today's agenda, we're going to look at 2023 US real estate market outlook. So what we'll do is we'll compare the outlook from January and the predictions made in January to mid-year outlook and see how things have changed and how things have progressed. Are we doing better? Are we doing worse? So we'll paint that contrasting picture. Multifamily supply and demand, how are we doing in terms of that? Rent growth, cap rates, all of these things mean a lot to us when we underwrite deals. So we'll see overall how the rent growth and cap rates are doing. And then also consumer spending habits post-pandemic. That has a big impact on overall economy. So we will be taking a look at that as well, how the savings look like. And finally, what do these trends really mean moving forward in 2024? So kind of like our take moving into 2024. All right, so this is more of a summary slide. So if you're looking at the economy overall, and most of this shouldn't come as a surprise. Everybody's talking about this. We are reading about this every day. We are seeing much higher interest rates in 2023 than we saw in 2022. The Feds did more than 10 interest rate increases, peaking at a 5.5% federal funds rate in July, end of July of this year. Thankfully, it seems like it has plateaued, and hopefully it begins to go down in 2024. Anticipated declines in home prices, which we are not seeing a whole lot of, and that's primarily because of the supply and demand equation staying strong. People who own homes don't want to sell them because they have locked in financing at 3.5%. So they don't want to sell those homes and move into a new home at 7.5% rate of interest, which is why there's still a pretty strong demand for single family homes, which are holding the prices tight. But at the same time, the mortgage payments have more than doubled. Retail sales and increase in unemployment as well. So increase in unemployment, yes, there is a little bit of an increase, but we'll cover this on some of our future slides, upcoming slides as well, that it's not so much of a bad news. Overall, the unemployment situation is pretty much under control, and the market's looking fairly strong. A moderate recession is expected in the US from late 2023 to early 2024. Again, the Feds were really hoping for a soft landing, and so far, all the signs indicate that we are really heading towards that soft landing. Now, in the history, every time the Feds have tried to do that, they have failed miserably. So we'll see what happens. But at least for now, the signs indicate that we are really moving towards that soft landing and a mild recession rather than a full-blown depression. Peak interest rates. So interest rates have peaked, and this was essentially purposely done by the Feds because inflation was really out of control at 9.1% in June 2022. So to curb that inflation and to cut down on consumer spending and to bring down some of that transaction volume, Feds started to raise the interest rate, and now the federal funds rate has peaked at around 5.5%. And that definitely has brought the inflation down. And the latest numbers as of this month are more like 3.2, with us closing the year, the projections are more like 2.9%. So that's definitely great news. So what the Feds are doing, it seems to be working. CBRE and Goldman Sachs both project the rates to start decreasing by mid-2024, and they'll probably not go back down to where they were during COVID times, which was like 3.5% or so interest rate and 0% in federal funds rate. Will probably stabilize at around 4.5%. So if you factor in the spread, maybe point and a half of spread, we are looking at maybe around 5.5 to 6% borrowing rates. In 2023, GDP growth forecast was at 2%, and downward adjustment for the GDP growth in 2024, as again, things slow down, and all of these things like increasing interest rates have a lagging effect. So the effects of these things in the economy, we typically see those 8 to 12 months down the road. So 2024 is projected to be a slow year with a 0.7% GDP growth, but which is still a positive GDP growth. So it's still not too bad. Again, 10-year treasury rates are at 4% at the end of 2023, and should be around 3.5% in 2024 as rates begin to come back down. And I think most lenders, you may have seen, lend based on your 10-year treasury rates, and would have a spread, depending on the bank, anywhere between 1.5 to 3 points on top of that. So that gives you an idea of where the interest rates would be in terms of borrowing. Steep downturn, not expected again. Soft landing seems to be more of the outcome that we'll see in 2024. Factors such as low consumer leverage and robust balance sheet provide stability. So consumers saved a lot of money during pandemic times, which provides a little bit of stability. But at the same time, we'll also see that during this last quarter of 2023, consumer spending has gone up, and a lot of those savings during pandemic times are now gone away. So is that a good news? I think we really want consumers to be spending for a healthy economy, but overspending is getting us into trouble. Growth drivers, key growth drivers really are digital economy and AI. We are hearing all about AI and how AI is going to change the world, and also reshoring of manufacturing, especially in the semiconductor production. So Samsung, Apple, Intel, a lot of these companies are bringing manufacturing onshore, and that's creating a lot of high tech or tech jobs, high paying jobs, which is again great for the economy. The impact of AI is still kind of unclear what impact it's going to have on overall productivity. We don't know that yet. That's yet to be seen. But China seems to be putting out AI out in the market a lot sooner, fewer regulations there. And we can already see that, things like DoorDash deliveries and e-commerce deliveries being done through automated robo-taxis and drone deliveries and stuff like that in China. And a lot of that is being piloted here in the US, and we'll see that come through in 2024 and 2025. Any comments, anything else you would like to add on this, Sean?
Sorry, I was just finding my mute button. No, I mean, I think you hit a lot of the relevant points. It's been a very interesting year. We'll talk about it in further charts coming up, but the big expectation is that we've already would have been in a recession, and we've basically kicked the can down the road, probably to more likely sometime in the first half of 2024. But I think you hit a lot of the salient points.
Awesome. Great. And so we'll have a lot of charts on these slides. We've tried to limit the words and really use the charts. And most of these charts are really self-explanatory. So in terms of GDP growth, this chart on the left shows how the GDP was, overall GDP growth was doing, especially when a lot of money was pumped in the economy. That fueled a lot of the growth. That slowed down in the post-pandemic era. In 2023, it slowed down significantly as the interest rate went up and cost of capital went up. And now the projections for early 2024 are pretty much flatlining like 0.7% GDP growth. So we will see a pretty measly GDP growth in the early part of 2024, but then it starts to pick back up as the interest rates start to come back down and more capital is accessible and banks loosen up their lending requirements. Similarly, on the slide on the right, again, it's showing you the projections made in January versus in September. So let's look at these Q4 projections here. The projections made in January for GDP growth in Q4 2023 for 0%, but we actually had 1.5% GDP growth. So things are looking more positive than originally anticipated. Inflation rate anticipated to be at 4.1% towards the end of the year. Currently, it's at 3.1 and anticipated to be at 2.9% by the end of the year. Again, that's great news, which means the inflation is now getting under control. Federal funds rate was expected to be around 5.25. We are pretty close, a little bit higher. I think the last increase in end of July was something most people didn't see coming, but we had one more at that point, and since then it's pretty much plateaued at about 5.5% currently. And the unemployment rate was projected to be at 4.7%, but we are at 3.88%. It is still at historical lows, so multi-decade low unemployment rate, which again is a great sign. And of course, the Feds are going to probably try to increase the interest rates maybe one or two more times because their goal was to increase this number a little bit, cause a little bit more pain in the economy before they start bringing the rates back down. But at least we are, I mean, most economists, Goldman Sachs, CBRE, Marcus Millichap, CoStar, all the data sources we look at, they all seem to align on the consensus that we are towards the tail end of interest rate increases. So at least there's light at the end of the tunnel now. With that, I think I'll pass it over to John to provide his insights on overall capital markets. John?
Yeah, so this is a lot of like what I deal in my job. It's kind of capital markets. So it's not only real estate, but it's companies coming to the markets to raise capital for different projects, CapEx, what have you. At the beginning of the year, investors were super cautious just because of a lot of uncertainties. We basically had a bank failure with Silicon Valley Bank that started to spill over to some of the other pockets of the economy. But even before that, I think just coming into 2023 after, the end of 2022, investors were pretty cautiously positioned. And then you had what happened with the banking system at the end of the first quarter, kind of just fed into that whole kind of thesis. So, the thought was we were going to have decreasing purchasing activity. And we'll show you kind of in the next slide how that hasn't panned out and the year's been better than what was expected. So we were concerned about rising interest rates, potential recession, and limited credit availability. None of that really panned out. Cap rates in the prime U.S. assets saw a very relatively or projected to have a relatively robust pickup of 100 to 150 basis points in increase from 2022. Obviously, much of that's being driven by what was going on with the Fed. So the Fed was coming out having risen interest rates by a very large margin in 2022, and they continued to do that in the first half of 2023. So cap rates obviously move with interest rate movements. So yields are projected to compress in the second half of the year. So once again, first half of 2023, many challenges in commercial real estate investment due to tightening financial conditions, what was expected to be a deteriorating economic outlook. But the expectation was what we're kind of projecting will happen in 2024 was that rates would eventually stabilize. And then the second half, we probably would get that recovery that Jay showed you a couple of charts earlier that we think now will happen in 2024, basically kicking the can down the road. The way I would kind of describe it and the way I describe it to investors I'm dealing with is that basically we'll have a mirror image of what we thought we had coming into 2023, and that will more likely transpire in 2024 instead. So CBRE at the beginning of this year forecasted a 15% decline in investment volumes in 2023 versus 2022 levels. So Jay, if you want to move to the next one. So kind of, looking at mid-year to the third quarter, as mentioned, the year hasn't panned out quite like us and the experts have thought out. So investors still relatively cautious, but, very different numbers. There has been a 60% year-on-year decrease in investment volume that really kind of transpired in Q2. That was once again banks literally shutting down, funding shutting down, and the economy just harder to get lending conditions from banks and get the financing you need. So still to sell a lot of the same uncertainties, what we were thinking about coming into the year around interest rates, economic outlook, and definitely tighter credit conditions. But once again, we feel like, or at least the prognosticators thought that stability was going to be expected by year end, leading to kind of increased investment activity. One mid-year review of the U.S. economy's resilience and higher than expected federal fund rates have led to a 125 basis point increase in cap rates for most property types. In particular, office is much more robust than that. We have seen increased in cap rates in other property segments such as retail and multifamily, but not quite to the degree as what we're seeing in the office space, just because with the work from home dynamic now post-COVID, it has completely revamped in what investors have and expectations for that individual part of kind of commercial real estate. Cap rates are expected to stabilize by early 2024 for all property types, except for, once again, the same theme, offices, which will stabilize maybe by mid-year, but it's going to be market specific, which generically, that's typically what you find in most real estate markets in general. It's all, you got to drive down to the individual property types and locations more than anything else. So due to economic resilience and higher interest rates, CBRE has lowered its investment volume forecast, and we'll show you some charts showing exactly that. The expected broad-based recovery initially set for late 2023 is now projected to begin. I would say maybe not early 2024 as we've seen more data coming out. I think the recovery will come in kind of the second half of 2024. So that's been pushed out further. And then investment volume is forecasted to decline. We have some charts showing this by 37% in 2023, but maybe look to increase once again the second half of 2024. The prognosis is by 15%. But still a lot of uncertainty in regards to what the Fed is ultimately going to do in the economic outlook. So, yeah.
Cool. And here are some of the multifamily numbers. So in terms of, we'll look at supply, demand, vacancy, and rent growth. So the forecast made in January anticipation was 350,000 or so units coming online in 2023, with about 141,000 in the first half and 210,000 in the second half. The demand, or the net absorption, was forecasted at 228,000 units. So of course, a little more supply than demand. And this is especially true in some of the Sunbelt markets, like Austin, Texas, Dallas, Phoenix, Arizona. Vacancy expected to rise to 5.2% by the year end due to, again, robust supply line. So a lot more supply than net absorption. And overall rent growth, at 3.5% in 2023 and 2.3% projected in 2024. So now let's look at how this compares to the mid-year actual data. So construction deliveries were actually higher than projected. So 450,000 units delivered. And this is a result of really cheap capital during the pandemic. And that led to a huge rush of construction during that time. And all of those units are now coming online. So we saw a lot more inventory hitting the market in 2023. But the net absorption was also higher than originally forecasted at 307,000 units, as opposed to 228,000 units. So it's still good news, but still a little bit of an oversupply situation this year. Vacancy rate will peak at 5.4% in Q2 of 2024, but rebalancing is expected in the long run at about 5% in Q2 2025. So really, it's not all gloom and doom. I mean, I'm sure most of us underwrite at 8 to 10% of vacancy anyway. So it's staying around that 5%, which is not really a bad news, So initially, the projections were that the recession is going to be a lot worse, but from what these numbers are coming out overall, of course, certain markets are going to be different from others. I think like Phoenix, Dallas have tremendous oversupply. So we are seeing slightly higher vacancy rates in those markets. But at the same time, there are certain markets, especially here in the Midwest, we still have significant housing shortage. So it's all market specific again. But this data is overall for the US. And then the rent growth forecast is adjusted to 2.2% for the year, again, due to a lowered CPI, lower inflation. And also another factor for a lower rent growth is the rent growth during pandemic time was excruciatingly high. I mean, it was crazy high, 24 to 25% in certain markets. And now we are kind of paying for it. It's all catching up. So that was about to happen. But of course, with higher interest rates and inflation going down, that number is getting adjusted as well. So this chart here again shows the supply, the deliveries in about thousands. So in terms of, if you look at the chart here going from 2023 up until projections in 2025, we see tremendous amount of deliveries in 2023. But then in 2024 and 2025, it's going to come back down because now new construction starts is really low because the cost of capital has gone up. So in the long term, real estate still makes a lot of financial sense to invest in this asset class overall in multifamily, because overall the supply demand equation is going to rebalance out in the following few years in 2024 moving to 2026. A few more charts, essentially everything that we covered on the previous two slides, there's more charts to back up that data. So essentially, if we are looking at vacancy rate, we saw the vacancy rate from 2018, it plummeted in 2021 during pandemic times. A lot of people moved in with their parents, moved out of their apartments. There was a lot of movement, which is why we saw pretty high vacancy rates. But it again skyrocketed when a lot of money was pumped into the economy. And now it's coming back down and more or less stabilizing. So overall, I think going forward, we are looking at about 5 to 5.4% vacancy rates, which are still pretty acceptable, as you can see here. And now this compares the vacancy rate across asset classes, class A, B, and C. And we can see all the charts are almost going parallel. So similar trends across asset classes. So it's not really a certain asset class that's getting hit harder than the other. In class B and C, primarily the vacancy has to do with the affordability crisis and the affordability gap increasing. And with class A, it's primarily to do with the oversupply that we have in the class A space. Here we have rent growth projections. So we are looking at overall US year-over-year rent growth. So we are looking at rent declines during the pandemic time, but then significant rent increases post-pandemic after all the money was pumped into the economy. Again, certain markets seeing as high as 24, 25%, but the average itself was still double digit, which is historically extremely high rent growth. Of course, this was not sustainable, so it had to come down at some point. And now, of course, with the interest rate increases, we are seeing the rent growth come back down. It should stabilize at around 2.5% next year. So 2.5 to 3% is typically what we underwrite for. So those are more healthy levels of rent increases year over year. And that was the whole intention of the Feds to increase the interest rates. So we are seeing that we are now getting close to more stable rent increases year over year. If you look at certain markets, actually some of the leading markets right now in rent growth are the Midwestern markets, because we didn't see in the Midwest tremendous rent growth as the Sunbelt markets were seeing 20+% rent growth in the last few years. We saw more like 13 to 14% rent growth here. But on the flip side now, in certain markets like Phoenix, where we are seeing negative rent growth, we are still at least maintaining a positive. I've highlighted Cincinnati and Dayton there because those are our target markets. Most of you guys already know that. We're also looking at Indianapolis now. So these are all pretty stable markets. So I think one of the analogy that I like is when the coastal markets are seeing an ocean surge, the Midwestern markets are more like being in a wave pool, right? And which is very much true. The highs are not too high, but the lows are not too low. usually the cash flows are relatively stable. So if you're an appreciation investor, yeah, you might want to take a look at other markets. You know, the coastal markets is where you would get most appreciation. But in Midwestern markets, we usually typically see a good mix of cash flows, appreciation, and a fairly healthy rent growth year over year. This is just the net absorption data. Again, something that we talked about. The surprise here was New York and also Chicago, actually. So a lot more absorption in New York, and that's mainly coming from the whole return to work initiative, right? So people are now moving back to New York City who had moved out, and that's leading to a lot more absorption. Dallas and Austin still stay pretty strong, and so does Houston in terms of absorption, because people still continue to move to the Sunbelt markets. So there's still pretty strong demand. I think the downside is there's also oversupply, but the demand is pretty strong still. But some of the other markets like Phoenix, Atlanta, which were also extremely hot, are now beginning to see a little lower absorption overall. So, and also in terms of rent growth, some of these markets like Phoenix are seeing negative rent growth, like I said before. This is overall completions versus net absorption by the quarters. So we can see that overall net absorption was a lot higher in 2024. Again, people moving back into apartments, a lot of people who had moved back with their friends or family moving back into apartments. So the absorption rates were a lot higher. They went back down in 2022, again, as interest rates began to go up. And now again, in terms of net absorption, we are seeing that it's going to be a little bit lower than the supply that we have, but still the supply and demand equation is not completely out of whack. So we have a little bit more supply than absorption, but then leading into 2025, that supply is going to come back down as new construction starts are going down, but the absorption rates are going to be pretty stable. John, anything I missed on these couple slides that you would like to add on?
No, I mean, I think you hit the nail on the head. It's kind of a rebalancing of the market, and you'll need some time for this to kind of negate and balance each other out. But I think like the charts highlight exactly, kind of the salient points. Once again, we're trying to hit how there is a rebalancing going on in the market, but I think it's setting up for what could be a very interesting year for real estate and multifamily in general in 2024.
Yeah, absolutely. Great. So I guess the key changes to the forecast, and that's where certain markets were upgraded while certain markets were downgraded from the original projections. So Chicago and New York saw significant positive revisions in rent growth and also absorption. And again, that was because of limited supply during the pandemic and post-pandemic. Now there's a lot more absorption than there is supply, because a lot of supply actually went to the Sunbelt markets and not so much to New York and Chicago. Some of the markets that were downgraded, so negative rent growth for much of 2024 with gradual rebound in 2025 and 2026. San Francisco continues to face challenges. I think affordability crisis, the rents are extremely high. And at the same time, with the work from home model, now a lot of people from the West Coast have moved to Texas, Carolinas, and other markets, which is why San Francisco as a market continues to struggle. And also the political situation, I mean, that's taking a toll on that market as well. West Coast markets in general hindered by high cost of living and sluggish return of residents, again, because of work from home, adding pressure to rent affordability. So I think the West Coast is really still suffering in terms of rent growth and absorption. So Austin, in this case, also, and Austin and Phoenix, really negative rent growth. And that's primarily because those were the two markets seeing 20+% rent growth in the last 2 years. So now there's a little bit of a catch up happening from that. So the rents were pushed to a certain level beyond which people were not able to afford those rents. So now, of course, with higher inventory, but also lower affordability, we are seeing negative rent growth in some of these markets. Same story continues. Rent growth, as we saw, increased, massive increase in 2022, end of 2021. But if you look at the latest data, it's projected to more like plateau and stabilize. So we are looking at really around 2% rent growth up until mid 2024 or so. And same thing here, construction starts, as I was talking about earlier, a significant drop in construction starts as soon as the interest rates started to go up in 2022 and 2023. When the interest rates were lower, we saw a sudden spike in construction volume, but now it's coming back down. So that should again readjust the supply and demand equation. John, I'll pass it over to you on insurance.
Sure. For anybody that's involved in real estate, multifamily in particular, I know Jay talked about going to the kind of the markets where you're near the coast to get appreciation. But the one caveat with that is if an insurance company hasn't already pulled out, your insurance rates have gone way up. And we've seen this kind of across the country. I thought this was an interesting chart that I saw and pulled out for this kind of presentation, showing just color coded. These are, cost of insurance as a percent of your OpEx. So, not only are taxes a big issue that you have to plan for when you're doing underwrite, but really insurance. So you can see kind of the markets, not only coastal, but have had issues. So California, between wildfires and other natural disasters that have happened to hit, and weather is way up there. Another one would be, Texas. So a lot of people have moved in. They've had a lot of issues from, kind of weather impacted in Florida. We've seen a ton of carriers move out of Florida, people in Florida struggling to try to find insurance. So it's kind of a phenomenon that's hitting across the country. Some of the country, some of the parts of the country that maybe not as well for appreciation would be your Montanas, your North Dakotas of the world. But you can see like the percent of your OpEx that's going to be increasing from insurance as a percent of that is a lot less. So once again, hitting that same theme that Jay's been hitting for most of this is it's really all about being market specific. So that will be a factor that you'll have to look at when you're analyzing the markets that your property is located in. So this is interesting. I mean, we've been talking ad nauseum about interest rates. The chart on the, all the way to the left looks at the 10-year treasury rate, which is what most mortgages are based off of. Obviously with the Fed in the market, very aggressive, raising rates over 500 basis points over the last couple of years. The treasury rate has spiked. It's kind of funny because at 4.5, it's way up from, basically zero around COVID, but, relatively speaking, it's still very low. But, it is important to see the trend that we've seen based on what the Fed has been doing on the short end of the curve. What's interesting is the play that it's had in regards to cap rates. So now moving over to the middle chart, you can see across the different, commercial property types, how it's impacted some more than others. But, it's to be expected. So as rates go up, the cap rates are obviously rising, in sympathy. So high correlation between the two. The worst of those being office and retail. Nothing earth shattering there, but we've even seen some, kind of, I wouldn't say spiking, but some movement in apartments and industrial, which are two relatively healthy parts of the commercial, space that people are investing in. And then lastly, all the way to the right would be transaction volume, just another chart. This is the way that JP Morgan's showing it, very similar to the way that Jay showed it. As rates go up, it's more expensive to borrow. I'll show a chart in a minute just showing how the amount of ability of banks lending out, so lending standards have gotten a lot more tight. So just with that and the cost of just generically speaking, new construction costs for insurance, what have you, real estate transaction volume has definitely decreased. And once again, that just hits it from a different angle that Jay already talked about. So, as I just mentioned, the chart on all the way to the left is the senior loan officer opinion survey. So if you were to kind of extrapolate this out to where we are currently sitting, it continues to go up. So lending conditions have continued to tighten. And a lot of that has to do with what we saw from Silicon Valley Bank. Also, because of the fact that the bigger banks have to at some point bail out and have to replenish the FDIC and all the support systems from the government that came in to bail out Silicon Valley Bank, they're just talking about how they have to have, you know, more and more capital on their balance sheet. So banks in general, in the short to intermediate term, until they can get by this hiccup, are definitely going to be on the more tighter side, which has implications for real estate markets. It's not as easy to get a loan, and if you're going to get a loan, your cost is going to be up. So there's the implication from that standpoint. Moving over to the consumer in the middle. So the consumer, for the most part, even though it was forecasted to be this way and it has played out this way, the consumer has actually been relatively strong. You know, they're still spending about the same amount of money. Once again, if you were to extrapolate this out further to the right, it's definitely, I would say, getting more stressed, because we've had, you know, student loans come back online, rates for credit cards, autos. You know, there's not really any transaction volume for people buying single family, but, you know, just rates in general across the board, everything's a lot more expensive. And I do give some credence to the fact that prices are decreasing, but I don't know, like everything that I spend my money on still seems like it's pretty expensive, and that inflation hasn't really come down. So I just think that the consumer is getting tapped out. They're still spending about the same amount of money. They're just choosing different pockets of where they're spending it. So travel's still pretty hot. People are still trying to make up for a couple lost years of COVID. So, you know, where they're not spending money is, you know, buying an extra pair of jeans or a new TV or what have you. So those consumer oriented goods, manufactured goods, are not flying off the shelves like they have, but consumers are spending more of their time and money on things like, you know, travel. Payroll so far still remain very robust. This is probably the last thing that the Fed's really watching in regards to inflation, because what's happened is with strong payrolls, the amount of money and raises and what have you, wages have continued to increase. That's starting to slow. The last couple of weeks of economic data releases, we've seen some kind of step off of the gas from companies continuing to have job openings out there. So I think the ripple effect will be that, you know, folks will not be able to flip jobs as much as they once have been able to, because the jobs aren't as plentiful, which will also lead into wages. I think the advantage will go back to the company at some point, and you won't be able to negotiate much like you had been maybe over the last couple of years when job openings were plentiful to kind of push whatever you wanted to make. And you can see the chart, how it's extrapolating, how it's not that jobs are going to fall off a cliff, but they're going to stabilize now, where they're not growing as much as they had been on a month by month basis. And that's where you see that red line kind of stabilize all the way to the right. So still relatively, you know, fine. And if you look at where we are from an interest rate perspective on the short end of the curve, in reality, we're about 4% unemployment. If you were to go back for prior history, we probably should be closer to 8%. So once again, it hits to the fact that for the most part, the Fed's done an admirable job of trying to slow the economy, slow inflation, but keep the economy still chugging along. And it has been pretty remarkable that we've been able to do this with pretty much full employment.
Yeah, absolutely. Awesome. Thank you, John. And next slide here, loan maturities.
Yeah, so this is a big thing that we talk a lot about as debt investors, but I think it has, you know, just as big implications for, you know, commercial real estate. And two is they call it a maturity cliff. So basically what this shows is, when are all the maturities coming due? When do companies or investors have to come to the market and refinance or roll over their debt? So as you can see, office is pretty much huge every year, but, you know, really boiling through the stack of maturities that are coming between now and 26 is massive. So that's why you're seeing a lot of the negative press out there in regards to office, because occupancy rates are not very good, because so many tenants haven't come back to full time, and they have this huge cliff, which could have, this will also factor into banks and the whole lending environment. Is a lot of, especially regional banks, are huge lenders to the office space. Is, you know, a lot of these guys will just walk away and give keys. We're seeing some of the bigger REIT companies and some of the bigger institutional investors just literally hand back keys, and because they can't get the rents and the occupancy numbers that they need to make the things work, so they'd rather just hand over the keys and walk away. Industrial's been strong, so as you can see, really no maturities, so that speaks well, and why I think that a lot of people are touting that part of the market. And in general, industrial should do well, because a lot of it is in regards to the way that our economy has changed. We're a just-in-time economy from a manufactured standpoint. So a lot of industrial, think about warehouses and things like that. So that kind of fits within that game plan and what how the growth of our economy has emerged. Retail already went through their hiccup. They don't have a lot of debt coming due. And in general, there is a lot of still dark spaces, but I guess for those folks that lend to retail, they already kind of went through their Armageddon, kind of 20 and 21. So as you can see, not a lot of maturities. The interesting one is multifamily. So think these are a lot of loans that were written. As you can see, if you look at the kind of the stack chart, a lot of that is coming due in 2026. So think of like 5-year loans. That typically is a very common term for especially multifamily investors, usually a 5-year loan. So that makes sense. A lot of deals were done in 2021. We've seen a little bit of a slowdown in 2022 and definitely a slowdown in 2023. So a lot of maturities coming due in 2026. So it's kind of something that you got to keep in the back of your mind. Because once again, these guys have to roll over their debt.
Awesome. Shifts in consumer spending. I think we'll just breeze through these slides because John, you covered a lot about consumer spending as well. But in general, yeah, the shifts in consumer spending, essentially high housing costs, rising credit card debt, shrinking savings, student loans, payments are resuming again, and car loans. So all of that is increasing pressure on consumers. So overall, the debt levels at the consumer level are increasing. Housing prices are pretty much at historical highs. So 41% of median income is going towards mortgage payments, which is crazy. So 40% of salaries going towards mortgage payments. So that's again at an all-time high, pretty much. And then also strong demand and limited supply contribute to challenge of affording homes. So we have, of course, the supply-demand equation that's holding the prices steady. So that's putting pressure on consumers. But at the same time, the cost of capital has gone up. So essentially your payments have more than doubled. So that's putting a lot of pressure on consumers. Now, if you look at overall consumer behavior, though, the debt is racking up. So if you're looking at 2020, 2021 through 2023, and that's across the board. So student loans, autos, credit cards, and other debt. So overall, we saw a record debt. So in 2003, so let's see, Americans are carrying a record high amount of debt with non-housing loan balances more than doubling since 2003 to reach approximately 4.8 trillion. So that is a crazy number. Again, so debt is increasing. So that's one sign that we should be looking at is how much debt do consumers have, because that's not something. Consumer spending is good, but this amount of debt is typically not good for the economy. In the past 2 years alone, we have racked up about $500 billion in debt. So that's pretty insane. Even the savings from the pre-pandemic. So this slide talks about that. So during pre-pandemic and pandemic era, the savings in American bank accounts were at all-time high. So you're looking at $2.1 trillion in savings. But as the markets have opened up, as things have opened up, a lot of that has already depleted by 1.9 trillion, so leaving only about 200 billion in savings. So again, that's a massive decrease in savings. So again, something to be watchful of, especially as we move into a slow period in the economy in early 2024. I think that was mainly it. That was the core content of the slides. So we have one summary slide here on just multifamily real estate and our take. What we are doing personally. This is by no means an investment advice, but some of this is just gospel truth, and it's going to apply no matter what market condition you're in. But it's pretty clear from all the metrics. If you look at vacancy rates, rent growth still positive, vacancy rates still hovering around 5%, that multifamily still remains one of the strongest asset classes. And it's also clear when you talk to brokers and lenders, they're still funding multifamily properties. So that's one of the asset classes that they're willing to lend on pretty easily. So this asset class still stays very strong. Make sure we are underwriting the deals very conservatively, more so than ever before, especially cap rates are beginning to decompress in most markets, and your expenses are going up, especially taxes and insurance. In certain markets, the insurance premiums have quadrupled, And no one saw that coming. So there's no way to underwrite for that. How do you underwrite for insurance premiums quadrupling? But now that it's happened, it's taught all of us a good lesson. So moving forward, we need to factor in that and have enough buffer for insurance premiums, taxes, and things like that. Focus on cash flow markets, especially now more than ever. There's a good chance anything that you buy now, the era of flipping multifamily is pretty much over. So anything you buy now, you're probably stuck with it for 3, 5, 7 years, maybe. So you want to buy properties that cash flow, if not day one, maybe in 6 months, but you don't want to buy properties that don't cash flow, hoping that you can increase the value and add enough value. So maybe year 2 onwards, it will start to cash flow. Day one cash flow is something to go after right now. Even if the IRR numbers are taking a little bit of a toll, I think focusing on that cash flow is crucial, because cash flow pays the bills by the end of the day. And that's what's going to sail you through during tough times, especially in early 2024. Focus on operations and efficiency improvements is really the key. Our mentors, Marco and Hadar, they always say, this is the year of operations. And I totally believe in it. Because operations and gaining efficiency, that is exactly what all the operators who have been in this business for 10, 20, 30 years, that is exactly what they're doing. They're trimming the fat, they're focusing on operations, they're sitting on liquidity, good liquidity, and now they're ready to go back in the market early 2024, when we didn't hit rock bottom, but we have pretty much bottomed out, is what most analysts would say. Don't ignore the market fundamentals. Again, this is probably common sense, but you'd be surprised many times people, to make the numbers work on underwriting, they sometimes ignore some of these fundamentals. But job growth, population growth, employment diversification, supply versus demand equation, how much inventory is coming into that market versus how much is the absorption, looking at those numbers, and your overall market makeup. Certain markets and certain neighborhoods, you have high home ownership percentage versus renters, and those may not be the best neighborhoods to invest in. Now, certain markets that have extremely high proportion of renters, 80 to 90% renters, those also might be tricky neighborhoods, because they tend to be C minus D neighborhoods usually. So you want to make sure that you have at least 30 to 40% renters in the neighborhood that you're investing in, so that you have a good demand for your rental apartments. And then, of course, irrespective of the market conditions, there are deals to be found in every market. As long as the numbers work, every market is a good market to invest in. And especially if you're locking in long-term financing. Agency debt numbers are now, again, manageable. I think today, 6.6% is the rate I got. So that's not too bad at all. So if the deal works out, and if it cash flows and the numbers are working out, and if you're able to lock in long-term financing, I mean, this is still a pretty good market to buy in. And especially after the cap rates have decompressed, I mean, people were buying properties at mid-2s and high-2 cap rates. When you're buying at high-2, how much cap rate compression are you going to shoot for? I mean, where else the cap rate's going to go? It's only going to decompress. But now that the cap rates have decompressed, it's again a good time to go back and buy properties at 6, 7 cap. And I'm talking about the Midwest. It's not achievable in all markets, but at least here we can find deals at 6 and 7 cap rate, and hopefully they again compress over time as the economy recovers, and then you're able to exit at a lower cap rate. Of course, underwriting for an exit cap rate is always a good idea. So you'd never want to underwrite for a lower cap rate at the exit. And finally, just buy right, finance right, and manage right. I mean, that's really everything about, in general, real estate, and specifically multifamily. You have to pay the right price. The money is made when you buy. We've all heard that. We have to keep that. We have to always remember that. We cannot buy based on projections, pro forma, and hopes. We have to pay the right price for the property. We have to use the right financing, and make sure, again, the operations are done right, because that's where really money is made, is operations. So I think that's all we had for tonight. Any closing comments, John, before we move to questions here?
No, I mean, I think your last bullet kind of nails it right on the head. Irregardless of where you are in a market cycle, it's going to come down to, even in the hot market, you can buy a bad deal in a hot market. So it's, once again, analyzing everything. And it's not just real estate. Now, I'm an investment guy through and through, so it doesn't matter what you're looking at. you always want to evaluate risk versus reward. And I think that definitely holds true in multifamily real estate with a lot of the points you mentioned on things you should be looking for.
Absolutely.
Awesome. Thank you both. I mean, this is huge. Very insightful information. One of the questions that Satya has is, with the optimistic expectation of rates coming down next year, is this the time to pick a value add asset or a stabilized asset? What do you guys think?
Yeah, we literally just had this conversation, John and I, last night. So I think everybody has their own perspectives. And John, I'll let you share yours because you have a very unique experience with one of your value add deals. And we have some challenges in some of our value add deals too, Alex, the property that we have worked on. So I think my personal take, by no means this is an investment advice. My personal take is I would lean towards buying more of Class B plus A assets right now if they cash flow day one, lower maintenance, lower expense ratios, your insurance, taxes, and some of the other expenses that you don't have control over are going up anyway. So at least you want to make sure that your turn cost, maintenance costs, repairs, those costs are staying a little bit under control. And when you're looking at 60s assets or older, there is a lot of uncertainty. And, your plumbing could have major issues, and that alone could be $50,000 expense. So to control some of that, I would be leaning more towards newer assets. And also newer assets are getting lower insurance pricing. And also the older assets that have cast iron plumbing, aluminum plumbing, they are getting hit hard on insurance, as high as 1,000 plus per door in insurance in the Midwest. I mean, that number would be a lot higher in the coastal markets. So that would be the preference. But now at the same time, if you're able to lock in good financing, right, over long term, and if you can really see a value add asset that's in a really good neighborhood, A or B neighborhood, and you can clearly see meat on the bone, and again, you're paying the right price for it, I would not be afraid to go after a value add deal. I would not do a deep value add deal now. So anything down to the studs, I would probably refrain from doing it because cost of capital is high. And thus your holding cost is going to be high, because a deep value add, you probably have to keep the property empty for 6 months to a year. And that's going to be an expensive and risky ordeal. But a light value add deal in a really good neighborhood and still newer assets, 70s or newer, or preferably a Class A or B property is what I would be leaning towards personally. John, your thoughts on that?
Yeah, I mean, I think I'm in a similar camp. And it's not just from personal experience. I just think that, in general, even if you're going to get stuff done around your house, things are a lot more expensive. So I would be looking more for kind of a newer property that doesn't need a lot of work. And the reason I think that the rates are forecasted to go down is, even though we're not going technically into a deep recession, we are going to go into a recession. That's why the Fed would lower rates to stimulate the economy. So once again, I think you want to be in a market that you're not as squeezed from a tenant base. So think probably maybe more workforce, if that's the part of the economy that's losing jobs. And each cycle is different. So once again, it's evaluating what's going on in the economy to see what exactly part of the economy is being hit from layoffs in jobs. Because we already saw it at the beginning of this year. There was a lot of high income tech workers that were getting laid off. So that had implications for the markets that these folks were working in. So each cycle is different, but I would tend to agree with Jay, because it just seems like getting a contractor, getting supplies that you think should be coming in at the prices that you're getting. I think it's a little bit harder to do a value add when you have so many things that are up in the air right now. So I think, to me, I lead to probably more stabilized than anything else.
Thank you for both your input, guys. Another question that just popped up is, with the insurance companies pulling out of markets, especially in Texas, Florida, do you guys see them staying out of the markets long term, like they're not coming back? Or do you think in the long run, 2 to 5 years down the line, they'll start to trickle back in? What do you guys think?
I guess I can start on this one, and Jay, you can add in. It's one of those things. Insurance companies are motivated by making profits. So the minute that they feel like they can make profits, they'll be back in the markets. This is just a short-term fix until they figure out, really, because we've had, to be honest, over the last few years, we've had so many things from weather and other events that have impacted, especially their underwriting, because for the most part, they're either storm related or fire or something along those lines that they're trying to forecast and, underwrite stability into their business plan. The minute there's no stability, they can't price anything correctly. So their first instinct is to shoot first, ask questions later, so they pull out. But I think as more players go in there and, kind of stabilize a market, obviously at higher levels, as we talked about, you will see eventually the markets will recycle and companies will be comfortable and come back into the market. It's just going to take some time. But I think we've seen it in cycles, over the history of markets in general. It's not just insurance companies, that the minute there is some type of profit potential in a market, companies will come back. That's at least my take.
Agreed. And that's exactly what I heard from a couple of insurance brokers I spoke to who insure properties across multiple states. They are actually seeing that in certain markets where certain insurance providers are pulling out, new providers are going into those markets. Florida is a little bit of an exception, again, because of the climate risk. There's more people pulling out than new providers going into that market. But for example, in our market, State Farm was the least competitive just a year or two ago. And it was mostly auto owners that was really writing most competitive policies. But now State Farm is coming in at the lowest pricing. So it keeps on changing. I think the providers, wherever they see they can make money, those are the markets. And I think the uncertainty in the market, as John has talked about as well, that's driving a lot of it, which is why the spread on borrowing has gone up with banks. They were at 1.5% spread and now they're at 3.5%. So the uncertainty and fear drives a lot of that, right? So once these insurance companies see that there are certain markets they can make money in, new providers will start trickling in. And we're already seeing that, actually. So.
Thanks for answering that, guys. Now, one of the questions that an investor asked us a couple of days ago is, with the market, the uncertainty with the market, what is really like the worst case scenario that could happen, that you guys foresee happen in the next, say, 6 to 12 months if things were to swing south?
Yeah, I mean, from an economic standpoint, I think the worst case thing that we could have is we could have a pickup. So we've been on a downward trajectory of inflation prints. If we get not even a spike, but if you get a reversal of that, the Fed obviously could go back to a more hawkish bet. That hasn't been the case. So I just look at, we went through a euphoric period, especially in the stock market in the month of November, because it felt like the Fed is done hiking rates, and we're going to be more on a trajectory of at least making a pivot relatively soon, where the Fed will start cutting rates because the economy is slowing. And I think more and more data prints have shown that. So the S&P just in the month, the S&P 500 just in the month of November was up over 9%. So I think that shows you the way that the market's thinking. So if you get a dramatic reversal of, I guess, against the grain of what investors are expecting, that could have a ripple effect on the economy. And you could just get the banks continuing to not, but I guess, be more restrictive, not lend out. So you could go into a deeper recession. Because I think at the end of the day, the thing that Chairman Powell's trying to do is he's trying to be more like Volcker, who was probably the most famous Fed chair for making sure that he killed inflation, even if that meant putting the economy in a recession. I'm not saying that Powell wants to do that, but his number one goal is to drive price stability. And there's been some other Fed chairs that have taken the opposite take, like Arthur Burns, who is known as one of the worst Fed chairs because he thought once he got inflation to start going down, he didn't finish the job and inflation spiked back up. So that could be that's what Powell wants to avoid. You do not want the economy shrinking and have inflation spiking, because that's deflation. That's like the worst thing you can have ever. And if you want, all these guys care about their credibility in the long run. So Powell does not want that. So that would be probably a worst case scenario. That's not being priced into the market. So that also would have a ripple effect if the economy was slowing much more dramatic than the expected, kind of predictions by most market experts.
Now, John, at this time, and Jay, you can answer as well, with the uncertainty, are there certain things challenges that we should be looking at in real estate investing? Like, here's some absolute things that you should stay away from, that we should not be, red flags, maybe, things that we're not really seeing, that that we could potentially, that could be downfalls in investing right now.
At least from like, and I think folks have already, Jay talked about this. I think the biggest thing is underwriting. Like, you can make any deal look fantastic based on your underwriting. And I can remember, trying to help folks look at deals, especially like 2020 and 2021, where, the expectation is back then inflation was, 2 or 3%. So most people were forecasting out the next 10 years from an expense ratio perspective, like growth and of expenses of like that low rate. So I think it's like, I think it's taking a fine tooth comb and like going over and over your underwriting. Because once again, you can make anything look great based on your underwriting, just making sure that you're probably being slightly more conservative, still, not necessarily killing a deal by being ultra conservative, but just making sure that even if it's another set of eyes, like going through to make sure that the deal still makes sense and you're not being too optimistic, because there is still a lot of things out there that, could be a lot of volatility in the market. So I think it's once again going through your underwriting and making sure that you're dotting your I's and crossing your T's and making sure that all your numbers that go through there make sense. Jay, I'm sure you have other things you can add to that.
Yeah, no, I think you covered everything really. In terms of risks, the only other thing that I think we didn't touch upon is the overall geopolitical risks, and those are very real. I mean, we're looking at 2 wars that are currently ongoing, so I think you got to keep an eye on that as well. I think that's the only other thing that comes to my mind. And also, US treasuries, they're at like 4.5% now, and the demand for US treasuries is kind of going down, right? I mean, China, Japan not buying as much US treasuries as they were, and that's again to keep the US treasuries more lucrative. They got to keep bumping up that rate, and now we are printing more money just to pay the debt on the on just to pay the interest on the debt that we already have. And that starts to put us in a kind of a dangerous territory. But again, this is more of a long-term risk, not a short-term risk. And Kiyosaki and some of these people have been talking about this for maybe the last 10 years. I mean, US dollar still is the strongest currency in the world and is the reserve currency. So it's still pretty strong. But these are, I think, some of the risks that I think we should just keep our eyes on in terms of the long-term horizon, I think.
So it sounds like underwriting, maybe have a second set of eyes looking at your underwriting as well when people are investing as well, even if you are a passive investor, to have someone else who knows what they're doing. Take a look at the underwriting and make sure it makes sense. If people are underwriting for 8% rent growth year over year for the next 5 years, it might be a little red flag.
Yeah,
all right.
That's a good summary, Alex.
All right. Is there any other questions that anyone else has?
And folks can actually unmute as well and speak up. So, yeah.
It's the after party right here. Nobody? Come on, guys. Marco, you just unmuted yourself. Go for it.
No, I just want to, something I think you guys covered was the savings during COVID. People weren't going away. I want to just touch on it for everybody. And it was a perfect storm of people not going away, saving money. Crypto was booming. Everything was working perfect. And in April 2021, we closed a deal in Columbus, and it was a $5 million raise, and we raised like $12 million in one day for that deal. We overraised. Now, just want people to realize we're closing a deal next week, and we funded it in 2 days. And deals are still happening and everybody's still funding them, but it's just a lot harder now. Like you guys pointed out, I want everybody to understand you guys made a good point on the savings. There was either 2 trillion or 9 trillion, whatever it was, a record in savings. Now people, when COVID was over, did you guys realize, Jay, you went to Italy this year. I saw like 20 of my friends in Italy. Did you guys realize that? So everybody, and Italy's not a cheap trip, guys. So everybody splurged, and then you're going into a recession, and a lot of people making a lot of less money. Like I'm still having a great year, but I'm making a lot less money than I did last year. You know, I know a bunch of people on this call are making, I'd say 90% of us are gonna, it cooled off. We had the bank crash that you guys pointed out. And that just scared everybody in the beginning of the year. So I think the deals are always going to be there. We're doing deals every year. I think you got to be self-aware of the raise you take on, you know, and at Sharpline, we were self-aware this year. We're closing a $2.63 million raise right now. We're not going after the 8-10 million right now, but we're gonna soon. And I think you guys I just want people to really pay attention to that going into 2024. And John talked about the bank crash. I think that was a great point for everybody to realize.
Awesome.
Absolutely.
Thank you for the input,
Thank you,
Marco.
Marco.
Okay. Well, thank you everyone for attending tonight. Those of you who want to chat more, I mean, we're really here just to help. We're here to help everybody else. And for those of you who want to chat more, click on the QR code, scan it, give us a call, shoot us, you know, an email, right? And let's connect and we'll go from there. Thank you guys so much. John, Jay, thank you.
Great. Thank you all. Thank you,
Yep,
John.
thank you
Thanks,
all.
Alex.
Thank you, guys.
Guys,
Appreciate
you all
it.
for joining.